Good morning. It's Friday, July 26th, about 6 a.m. Central Time. Overnight, the precious metals are mixed after yesterday's sell-off. You have August gold up $19, $23.72. If you're going to trade gold, look at October or December. December is probably where everyone's going to end up going. If you look at September, silver, about unchanged right here, $27.92 in the middle of the range, $28.22 being the high, $27.75 being the low. So volatility, it continues to grip these markets here, and it's really fueled by the equity markets and specifically the NASDAQ, where we've seen a concentration of stocks really fuel this latest bull market. You've got the Magnificent Seven, and two of those dominoes started to fall this week with Google and Tesla, and it becomes this domino effect. That's where the volatility had really surged in the markets. And with the NASDAQ being up 200 points, S&P up 40, I wouldn't even flinch if they went negative here on the day. So looking at the precious metals markets here, couple things. Scores on the board. Look at the week to date here. Silver, worst performing commodity, down 4.67%. So got to give you a little bit of an uneasy feeling, but sometimes the dogs are the leaders just because last week we were one of the best performing commodities out there. Gold market down 1% on the week. You look at palladium down 1.47, and then you look at platinum down about 3.5%. So a lot of pressure in precious metals across the board. Now looking at a few things here, we are going to have the PCE data come out here today. And I think the PCE data, definitely the most important thing. It's going to be the directional movement that's going to either give gold the snapback recovery it needs or the continued breakdown. So expectations are for 0.2%, a slight uptick from previously, which is 0.1. We'll also have personal income, personal spending, University of Michigan consumer sentiment, also University of Michigan inflation expectations. So quite a bit of things out there. I think looking at your tactical support resistance, 23.43.20 on the gold market, 23.80 on the upside. So we almost approached that level in the overnight session here. So the liquidation in precious metals is kind of taking a pause. Traders are really waiting for this inflation data. So I did mention to you guys several times, if the gold market cannot hold 2,400, chances are we're going to go down to that 50-day moving average, 23.75. That proved correct here yesterday. We did break below the trend neutralizer level, which is 23.58.60. So gold has shifted to a neutral trend. Now, neutral trend is not something to have serious concern about. It's just a wake-up call in the market you're in because gold has had an incredible rally. It needs to consolidate a bit here and figure out its own issues before it starts to pick one direction or the other. And I think that the PCE data is really going to add that fuel here. So looking at the July 31st Fed meeting, the probability of an interest rate cut, 6.7%. So it was about 10% yesterday. That's come down quite a bit. I think cementing it will be the inflation data we get here today. Looking at that September meeting, you've got a 89.6% chance of a 25 basis point cut, 10.2% chance of the 50 basis point cut. So two things really to look at here. So you get back down to the levels here. It's going to take a move above 2,400, 2,434 in order to shift the market back to a bull trend. So when gold gets to these kind of levels here, what you want to do is, again, you're looking at the swimming pool. You don't dive into the deep end. You start to wade in there. Look at those 10-ounce contracts. Look at the options. Look at the call spreads. They even have micro options right now in the 10-ounce contract. So there's really no reason why people wouldn't consider having some exposure to futures because of the fact that you could have that limited risk with a 10-ounce gold contract and just start to stick your toe in the water here. So pivot point on the day, 50-day moving average, 23.75. Your critical level of support going to be right around those lows, 23.50 down to 23.45. The bear trade trigger, we don't want to see that gold market go below 23.39.60. That will trigger a bearish move in a chart pattern that looks similar to the silver market. Now getting into silver, big uptick in volatility yesterday, $1.53 move. The silver market historically over the last 2 weeks has had about a 94-cent move per day, and we saw this big uptick here. I warned you last Monday when I started writing the Metals Edge that the DMI minus was looking to cross over at the plus, and that's one of the things that I use to scan across all the commodities markets, because oftentimes it's a shock and a wake-up call and an increase in volatility. I saw some of those moves happen in the agricultural markets, and look, we got a huge recovery in the agricultural markets this week. So futures really in the silver market, they need to stage a recovery. You look at silver, it's been disconnected from that gold market. The gold-silver ratio right now, big uptick here recently. We're at 85 to 1. So we got down to about 72, 73 to 1. That was when silver was at its peak. I often say that you need several things in order to silver to really hit that $35, $40, $50 an ounce. You need China coming back. You need a robust Chinese economy. You need copper demand. You need supply strained. Supplies are strained right now. There is a demand picture here for the silver market with a lot of different things moving on, especially solar demand. You look at from 2020, from 2015 to 2020, they were pretty flat. They were in a range, 60 to about 100 million ounces. All of a sudden, you get to 2021, 2, 3, and 4, you get this massive uptick, and that increases that supply deficit on the silver. So supply demand, you've got it. You've got what you need. The structure of the market where you need China to come back. Trust me, you need China in order for silver price to take off. You need ETF investors to come back. And the thing is that futures need to do one of two things in order to get going. They need to have, and you don't want to hear this, more of a significant breakdown to attract buyers. They say that the cure for lower prices is lower prices. It sparks that demand. People will start to wake up and go, oh my God, silver's back below $30. It's 26 bucks. It's at the 200-day moving average, whatever it is. We need to add some of this allocation to our portfolio. It's too cheap per se at these levels, and people will start to come in and start to allocate towards it as a longer term core holding. Or you need the other development. You need silver prices to go $30 overnight, 31, 32, 33, and people will go, oh crap, I'm gonna miss it. I need to get in. And that's when gasoline gets thrown on the fire and prices take off to the upside. So I've traded silver for 25 years, the futures contracts. I mean, I've got a pretty good pulse on what that market is. So bit of a runoff here on the markets. I have the Metals Edge. I wrote it up. I think it's a great piece. I touch base on volatility and how to measure volatility. Be sure to check that out. If you don't get it, send an email to info@bluelionfutures.com. Love to get it over to you. So remember, futures option trading does involve risk of loss, may not be suitable to all investors. Good luck, good trading.